Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, March 5th, 2020. This market recap will be largely for for public content. Those that follow either the YouTube channel or come into Right Side of the Chart for the free content. Right Side of the Chart is a freemium service. That means both premium and free content. The free content is typically any educational material, some educational material, and general stock market analysis. But when we have an official trade, which we do now once again on QQQ, then I kind of go a little dark on that and keep the at least the price targets and exact levels and some of the the nitty gritty. That is public content. I'm sorry, premium content up until that trade is closed. So we're going to start out here. The last trade on QQQ official trade we had just here. I think what did we enter that on Friday? I believe because we hit the would have been I think Friday. We hit that for about a 5.5% gain right here. We got a quick 5.5% pop out of it, 1 day gain there, and hit our second target. And at the time I had stated, although I'm an active trader, especially when volatility is like this. So I wear multiple hats. I'm a swing trader, trend trader, investor. Also, when volatility is high, I've been day trading quite a bit. Probably a dozen in and out trades today. On futures. Market has been extremely conducive to day trading lately. But as far as swing trading, I mentioned I had some accounts there, and although that was the official final target there, I gave a potential target here at T3, which I had all intentions to hold out on those swing positions, trail stops, and I think that would have been hit until Tuesday. Everything changed on Tuesday. Things were going well. We were up again over Monday's highs, and then we got what I refer to as Powell's folly. I think it's a big mistake, and I made the point to put the video together and share my thoughts right after that. We had a big pop on that 50 basis point announcement. Remember, that's an emergency rate cut, meaning it comes between. It's an emergency rate cut is an unannounced rate cut, comes between meetings. Historically, you look back, and there's mixed things here fundamentally. I don't want to spend too much time on this, but historically, you don't get those emergency rate cuts. You get them at times when the market's in distress. There was one I referenced back in 2001 where you had the biggest day ever in the NASDAQ. I think it went up like 14% after that emergency rate cut. And from there, it turned around, never looked back, and fell. I don't know what it was. I had it on the stats. I wrote this down somewhere, shared it on the site. It was 30, 40, 50% drop from there. And in fact, it said investors would have been better off waiting years to get into the market. So, and the same thing happened in 2008. Remember, we had emergency rate cuts, and those didn't. There was a lot more downside from there. And so my takeaway, why I didn't like it, why I got out. I told everyone I had on those swing positions immediately into that pop, sold about 2/3, 3/4, and then tightened stops up on the rest, which were all I'm out of those now. And I did it for a couple reasons. Number one, I think the rate cut wasn't warranted at this time. The market was recovering. It was on the way up. It was rallying. And I think it sends a negative message to the general public. What does the Fed see? Do they see something we don't see? Yeah, we all know about coronavirus. Is there something worse? Is there a bank or a hedge fund or something blowing up? That's a real risk when the market drops suddenly like this and everybody is on a one-sided trade. You only get that after such a period of just a slow, steady grind higher. Complacency rules the day. That's what it is. Everybody's not everybody, but a lot of funds and portfolio managers become complacent, become excessively bullish. They don't see any dark clouds on the horizon of the economy. So not only are they all in long, but they're long on leverage, and that's what blows up both individual investors and institutional accounts. So that's one of many things. Banks can come down from that too. Banks are always dabbling in the market. And anyways, sudden drops like that aren't good. So again, the fact I think the rate cut came at a very poor time, and you don't have a lot of dry powder. Yes, the Fed had a few hikes that got off the bottom recently, but we're still, relatively speaking, interest rates are on the floor, and there's not a lot of downside left. So by Powell pulling out the bazooka at that point in time, now it leaves him with virtually no dry powder. Yes, you can cut another quarter point. Yes, you can even bring rates down to zero, below zero. But hey, that didn't work so well for the majority of countries that did that in recent years, did it? So I don't think a negative interest rate policy in the U.S. 10 plus years, almost 11 years into the longest expansion in history, I don't think it's going to really do much to stop the inevitable. Okay, long-term stuff. I'm going to get off that fundamental ramblings. And what I told subscribers is it doesn't matter whether I'm right or wrong on that. It's what the market thinks. Are they going to like? Will the masses like the 50-point rate cut? That's a lot of juice injected into the market, and that's all that really matters. So we'll see. So far, we're still off the Powell pop right there. It is. We closed the day today about 3, almost 4% below the peak of the Powell pop right there. That's it. That I'm talking about the top of this candle here on Tuesday. We were right about here, testing those highs, popped it, and then boom, fell off. All right, so we shorted that day. We're short. We're still short on that. These are not the targets. These are the last trade, and that's why, like I said, I think it not eliminated, but significantly reduced the chances that we're going to go up there. I think we may have started the next leg down. Now let's get to the levels to watch, and I'll show you what will determine that. Okay, so today, again, if you're a subscriber, this is largely a recap of everything I've already covered. These are the new revised uptrend lines to watch. We have it on QQQ, which we're looking at here on a 60-minute time frame. It's the uptrend line off last Friday's low. That's a very significant low. That was so far the end of the drop. Again, so far, maybe it'll prove to be in hindsight, but maybe this is just a bounce along the way. We have a lot of reactions, and I pulled that trend line. Seems to keep wanting to walk for whatever reason here. I got to tighten it up. There we go. All right, so we have a lot of reactions along there. Multiple candles. There's 5 right there, 6, and then today we had a few more reactions. And so I posted, watch this, and you get a sell signal if both QQQ and SPY break down. Boom, there what it was. I said, you want to see a solid 60-minute close, and the more impulsive, the better. That's it. And then we went lower from there. You're looking, this is the after-hours trades right here. We're flattened out in after-hours. That's where we closed. So that is a breakdown. However, there are a couple other things. I'm going to give you everything here because the bears have not won this yet. It is certainly a check mark for the bears today. That breakdown was a check mark for the bears, but the uptrend, as I've stated earlier today, the near-term uptrend is still bullish. What am I talking about? Let's get rid of all these lines. Here's your longer-term trend. All my longer-term trend indicators, my longest-term trend indicators, that is, weekly, monthly charts, are all bullish. No doubt about that. You go back into weekly charts. I've did some videos recently sharing some of those trend indicators and monthly charts. They're bullish, but if we go down a lot, quite a bit more, they certainly are at risk of flipping to bearish, but for now they're bullish. Then you have the intermediate term trend. This is the last several weeks right here. And then you have the near term, what I refer to as the near term trend. So bullish long-term trend, bearish intermediate term trend, bullish short-term trend right now. Despite that trend line break, you might say, well, Randy, that trend line broke. All right, but what defines a trend, and that trend line is one thing, but I've had to draw several trend lines recently, in revise. I always say my analysis is dynamic because the charts are dynamic. They change every day. So they got a trend line there. We broke it. Then you set up a trend line there, and now the one I just showed you there right here. All right, so that one's broken. And but I will say that as of now, the bullish trend is still intact. It's called into question recently because what defines a trend simply is a security making a series of higher lows, which we have here, and higher highs. That's what we have here. Now, the fact we failed to take out Tuesday's highs does call it into question, but we still have a series of lower heights. In other words, if we jogged up tomorrow and did this, let's just say, then you have still the makings of an uptrend here, right? All right, so that's the near-term trend. So what I'm watching for, stated earlier today, is a break below Tuesday's lows, because that would certainly be another check mark for the bears. Whereas if we can hold that and go out and take out Tuesday's highs, that's going to be a check mark for the bulls. So those are the levels I'm watching. And then before we leave this 60-minute chart, there's two other things I'm watching. The PPO here, I use it in several different ways. As you guys probably know, I'm a big divergences are a big part of my analysis. It's pretty simple stuff here. I warned of the divergent high right here, leading up to the recent highs, and that was a catalyst, for the correction there, or at least it foretold likely trend reversal. Then we set up here, we had on SPY, but you don't see it here on a QQQ. You had a divergent low right there. You have a equal or higher low in the PPO and lower low in prices. So there was your positive divergence at the low. We did not have it on the PPO, although slightly right there. And the other way I use it, and that's what we're going to do now, is a trend indicator, and it does a pretty good job. I like to look at the 9 EMA, the signal line. When it's above that dotted line, the trend is bullish. You can see you want to be, or at least it's confirming that the trend, the near term, or intermediate term trend here on a 60-minute chart is bullish. When you cross down right here, the white line crossed below and stay below to right here, it said the trend was bearish. And although there wasn't a big short to be made, the market stalled out and it consolidated. So would have been, you could have been out, or at least using this in conjunction with other things. But then it said right here, we crossed back over bullish, new bullish trend, and boom, there crossed bearish. Now we just popped over recently, but we're not over by a large margin. Sometimes you get these little whipsaw signals. You cross and then you get right back up there. So this could be a whipsaw. And where I'm going with this is we should know in the next day or two. Markets probably aren't going to consolidate much longer, not in a very tight range. If we cross back down on the PPO signal line, that white line solidly below here, and take that level out. So those are the two things I'm looking for QQQ. Tuesday's lows, plus this PPO signal line to move down. And then finally, it's very simple and pretty effective, is a simple bearish crossover on the PPO. Here, one way to see it, let's move this down and let's just put up the histogram. The histogram will show us when the PPO crosses over. We'll park this one up top and right here, and that's it. And I like to see clean separation on the PPO. That means I call these hills, these big hills, red or green hills. That's when the PPO line is above the signal line. You're going to be green. There's a bearish crossover right there. Last time we were green here, we had right there. There's your bearish crossover right there. If you took that signal, and again, I don't trade it. I don't trade solely on this signal. I use it in conjunction with other things. So what were those things? Well, today we had the trend line break, but we need a little more downside to take out Tuesday's lows. So if this continues to go red tomorrow, it's going to say, hey, the trend has flipped to bearish. And what I've been saying recently is that we'll probably, if we get anywhere even close to those lows from last Friday, I think we'll just plummet down right on through there. I don't think we're going to meander down through there. I think it'll be a pretty quick move, then down to the price target on our official trade, which is quite a ways below these lows right here, and certainly quite a bit of a ways below where we close the market today. So that's what I'm watching for on QQQ. I just showed you what would firm up the bearish case. Let's show you what would firm up the bullish case. This is these two yellow lines that I just drew here. It's a triangle on QQQ 60-minute chart. So there's your downtrend line. We broke the uptrend line. So a pop above this downtrend line, number one, that's your first resistance level. The 218.16 level is a pretty big level. We look at, just take everything away. Remember, we had the high yesterday, which fell a little shy of Tuesday's high. Now, all this was just the algos going crazy on the initial announcement of the rate hike. But it is a reaction high, so it is a level to watch. You take it out, that's bullish. And again, I had a level here. You take out yesterday's high, that's going to help. So we're really not far from it from where we closed today, about another maybe 3% or so to the upside. to get there. And then we got to pop that, and that would quite likely open the door up for a move for that potential third target that I had up there about 224.45. I already showed you what to look for on the downside. I've made it clear that I'm leaning towards that. I flipped back to bearish the other day because of what the Fed did, and leaning that way, but there's work to be done. We're right now in a consolidation range, and you can see we're even above this support line here. The PPO, I pointed this out recently. We had a bearish crossover on the daily as well. It works very well as well. And you can see the PPO signal line has crossed down into bearish territory. And it works very well in trending markets like this, when you have a clear trend and it gives you this signal and then it crosses back over, where that PPO or any trend indicator, I don't care what you use, moving average pairs, anything else, trend indicators work great in a trending market, and they work really lousy in a choppy consolidating market, sideways market. This is sideways consolidation. All of this was sideways. So what you see here is a few whipsaws on that PPO indicator. But when you go back in time, which I'm doing here, I'm rolling back, you can see it does a pretty darn good job of defining bullish and bearish trends, above or below zero. Bullish trend, bearish, and it did. It wasn't a lot, but it certainly caught that down move. And again, this was a little whipsaw. We were consolidating here for a while, but it for that whole period of time it was bullish. So we've crossed down below, and that's now you also have a lot of support, as I've discussed recently, below. In fact, we're sandwiched. Really, the market has a lot of significant resistance overhead and quite a bit of very important support below. So if we break the recent lows, that's not going to be a good thing. And again, I've already laid out at least an initial downside target. So for those of you on the site, that is, we only have a sole target, a single target. I'm keeping this trade simple. But there is certainly the potential for more. So I may add additional targets if and as we get close to that downside target. Let's look at SPY and then the futures, and we'll wrap this up. Almost the same story on SPY. Let me turn all the lines off here. You have, some key moving averages right here. These two lines you can see on here are the 200-day exponential moving average and the 200-day simple moving average. You have a blue and a red line, and they do a good job of defining trends. The market's bullish when above those, bearish when below. We overshot them here, so this can be at this point chalked up, and this all can be chalked up to now as what I call momentum fueled overshoot. We had a near vertical drop off the highs right here, and so it's not uncommon to see a support level get overshot only to be recovered. But since then we've been consolidating on those, so we didn't just regain them and take off. We're testing right now. You can see the market is bouncing around these 200-day simple and moving exponential moving averages. So very important levels. So whichever way we break from here has the potential to determine the next 8-10% or more move in the market. If we can't hold those and get rejected, that's going to be bearish. If we can hold them, it's bullish. But like I said, it's not necessarily off to the races, 20-30% new highs. It is possible, certainly possible, but a lot of work to be done, including this mega gap from a couple weeks ago right there. All right, so that's what SPY looks like. Take it down to the 60-minute chart. Same trend line off the lows right here. Friday's low broken today with a nice red candle. Now, again, these were highlighted earlier. For whatever reason, they keep drifting here. I'm going to move it back up, put it where it should be. You can see what I'm doing. I'm fitting it tight to the bottom of these candles right here. I look for the most number of candlestick bodies and or shadows, the skinny part, to come in. So I think trend line drawing is more of an art than a science, but I think that's a pretty good fit right there. And the fact it was pointed out in advance and we broke it, and we took it out, we didn't limp down through it. You had an impulsive candle, and then that's where we're at right now. So we had that was a sell signal triggered on SPY, at least a near-term signal. But just like QQQ, we have that low, major reaction low from Tuesday. You take that out, and that's around 297.50. Now you no longer have a near-term uptrend. It's been negated at that point. Likewise, we have roughly equal highs right there from the Powell pop right here. to that high yesterday, and that's resistance. So like I said, the uptrend line is starting to be called in question. The uptrend itself, because of that uptrend line break today. However, the uptrend is not completely eliminated yet. It's still intact. We still have a higher low over that previous low, and so this is it. I think we'll hopefully have a good idea tomorrow which way this goes, and it might give me confidence to either add to my short positions or on the swing accounts, or either sit tight for now and stick with the trading plan. They came close to our stop the other day on QQQ, but they didn't hit it, so we'll just sit tight and let the charts play out. So I've told you where I think things are going. Here's the PPO right now on SPY. There's a bearish crossover recently, like I talked about. We got that today. The PPO signal line has crossed slightly down below the zero line, not by enough to say, okay, well, let's dive in short. It's not like that. This is effectively a back test right now. Bullish trend here, bearish trend here, and it crossed over but it crossed back, so I'm not calling it a whipsaw, I'm just calling it a test. We're testing that level. It often acts as support when above and resistance when below. You can see here, right here's a good example. We were in a bullish trend at this point in time, and that PPO signal line came and back tested several times, and it kept the trend intact. We had little pullbacks in the market. They don't look like much here because I've just squashed this down, but it's just an example that once you cross down, you get a solid cross, you'll know it. So that's what I'm watching for tomorrow, and we'll wrap it up with the futures. Same trend line. This one I had even yesterday and the day before. This is a trend line I've been tracking on NQ. Broken today. Breakdown. A perfect back test of it and a rejection. That's TA 101. There was a short entry there. We hit that 82 or this level I was watching trading off today, 8,700. It's a level I've been harping on for a while on NQ. Broke down, back tested, hit that level, or I'm sorry, hit the 8,700 level, then back tested, and then moved lower. We have support here about 8,652. I also mentioned the last couple sessions, I pointed out how this rally so far has been stopped cold at the 50% Fibonacci retracement. That is a move off the highs. If you take a measurement from the highs to the lows, it means we retrace. That's a key level, a key Fibonacci retracement level. We were rejected there both times on the Powell pop and yesterday, and that's a typical counter trend bounce and a larger downtrend, if that is what this is. So we also have price resistance. I had a price resistance zone there as well, and that's it, guys. To me, it's again, at the risk of oversimplifying it, bulls need to get it up above that level, those highs from yesterday and Tuesday. So far, they've been rejected. The ball is in the bears' courts to take it down. Bears can take it down here. You have some support. You also have the 23.6 fib there, and price support about 85.05. So if we move down tomorrow, take out 85.05, that should be it. You still have that major low from Friday, but I think this will do the trick to the downside. Anybody's game right now. That's what I want to say. It's not. I can't tell you with the highest degree of confidence this market's going to jog and take another leg down. My confidence will go up if those levels that I covered there are taken out. S&P 500 futures, same story. And it looks just like SPY. You have Tuesday's reaction low. We're still above. So as of now, near-term uptrend, as you can see, is bullish. Certainly called into question today. I had this yellow trend line. This is what I call the benefit of the doubt or secondary trend line. Both were taken out today, back tested, and you have this little downtrend line that's setting up here. Could be near-term bullish if it's popped, but really the bulls have to take out those highs from right here, that level. And that also, the ES and SPY and QQQ, by the way, they all on the button hit these 50% Fibonacci retracements so far, and that has capped the bounce back. So we're building energy, and what I had said earlier today to subscribers, I think if we even get close to that level again from where we are, what happened today, if we get close, we're probably going to pop it and run. That would be my guess. Now, I always say resistance is resistance until unless taken out. We could certainly come up for a third test and get rejected. Anything is possible. I'm trying to draw a line tool here, arrow tool, but that's what you want to watch. And to the downside, like I said, not much more. About 29.74. You get a little more support there around 29.51, but if they take that out, then that's probably going to trigger another wave of impulsive selling like that is what I would think. All right, so we'll wrap it up here. You have plenty of levels to watch, and really they're all the same levels. I covered 4 different charts, on the 60-minute time frame, but they're the same thing. They're the futures and the ETFs, and so the levels all come in roughly together right now. And that's the other thing. ES and NQ are pretty much in sync right now. You're seeing almost as much price swings in ES and SPY as you are in NQ lately, which is unusual, but that just shows you there's a broad-based sell-off right now, or broad-based selling, I should say, in a lot of the sectors in the S&P 500 that usually hold SPY up a little bit more during the market drops. But either way, it makes for nice charts because they're in alignment. And what you want to see is, you want to see them both break down or both break out to increase the odds that that buy or sell signal will stick. All right, we'll wrap it up here and pick it up. Well, it depends. Depends what happens tomorrow. But subscribers, I'll certainly get something out to you in the morning like usual. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.